The 721 exchange, similar to the 1031 exchange, allows an investor to defer capital gains taxes while relinquishing control of a property held for business or investment purposes. Both tax mitigation strategies offer investors strong alternatives to a traditional sale, in which taxes can exceed 20 to 30% of capital gains. The 1031, however, may not meet the goals of some investors. For example, an investor may be attracted to the stable income, tax benefits, and potential appreciation that can be provided by a REIT investment, which would not satisfy the requirements for a 1031 exchange. In a 721 exchange, a real estate investor contributes property to a REIT in exchange for units in an operating partnership that will then be converted into shares of the REIT itself. Every REIT has specific acquisition criteria. However, it is unlikely that the property a given individual wants to relinquish meets the criteria of the REIT the investor wants to invest in. The solution is to combine a 1031 exchange with a 721 exchange, which allows one to acquire a fractional interest in institutional-grade property that meets the criteria of the REIT the investor wants to invest in. This fractional investment must be held for a sufficient amount of time, typically around 24 months, to keep a 1031 exchange intact. The good news is that the investment may pay dividends out to the investor throughout this period. After this point, the fractional investment can be contributed to the REIT in exchange for operating partnership units based on the value of the property. These units will then be exchanged for direct ownership of shares in the REIT. REIT shares themselves are not eligible to be used in a 1031 exchange. And therefore, once a 721 exchange is completed, this is the end of the line for deferral of capital gains taxes. If the shares of the REIT are sold, or the REIT sell a portion of the portfolio and returns capital to the investors will be required to recognize any capital gain or losses when they file their taxes.